Hello everybody, and I haven't made a video for a while, primarily because I have been really busy starting up this new managed account that I'm working with, and so I apologize for not making a lot of videos about trading per se, but I decided to do an example here of I think I mentioned to you guys before that when you manage money, you can't take risk. I don't take the same risks when I'm managing other people's money as I do with my own account. So, what do you do? Well, what you have to do is you have to find a way to offset that risk. So, just to give you an example of a trade that I did this morning, it's all here, okay? Um, you can see that I shorted EXC and I bought PPL, okay? And then I covered the trade. So it's all here. These are live trades. And I want to show you on a chart why I did that. And, for my students primarily who are curious, to what you can look forward to in the future when you do manage money versus what you're doing right now. So, EXC had reported earnings tonight, or last night, or this morning, can't remember. And you can see that they actually beat earnings, came in at 55 cents. Let's see if I can get this up here. Earnings of $61.61. That there. Estimate and actual was 55. So they actually didn't beat. They actually missed, forgive me. And that was before the market central time today. So when I was looking at how I wanted to exploit this situation, obviously I think I want to short this asset, but I don't want to just short it and be naked on it, right? Now, my students will go out to a larger time frame here. If I just zoom out to a larger daily time frame, it's a bar chart, but you can do a candle chart. You can see that why I wanted to short EXC, okay? But I don't want to short it naked, right? I always want to be, when you're managing other people's money, you always want to be controlling that risk. So the white candle right here is EXC. Okay. Now, when EXC pops up and pops up higher, if I compare it to something else that's very correlated to it, I now can have a way of putting a hedge on this trade, or it's called a correlation trade, okay? And EXC pops higher, I want to short it, I get a signal up here that I want to short it, but I don't want to short it just naked. I take the PPL long, okay? Now, we can see that these pairs move very closely together. See this? This stock moves very, very closely together. So when you find a stock that is pretty much highly correlated to another stock, you can do these trades. So I had to first of all find the PPL to take with the EXC. So when I short this, I simply went long the PPL. Okay, and that's the trade that you're seeing there. Now, it wasn't a really big winning trade. It ended up resulting in about, not a lot, it's not a huge amount of money, about $300, $400 after commission. But, it's a nice return. That is a decent little return on an earnings trade, which allowed me to take a position, but rather than being fully exposed on that position, basically to have a way to make sure that that trade did not get out of control, and if I was completely wrong, there would be a way for me to manage that trade by having the other side. Okay, so why is that important? Because let's say I was completely wrong about PPEXE. If it continued to go higher, well, this other correlated pair would probably follow it higher. And now I can manage that trade so much more effectively. When you just take a short, what's your options? Right? If you just take that short, what's your option? Your option is basically you got to be right. And if you're wrong, you can use a stop, and that's really your only option. But what would happen if you were actually very right about that trade? Okay, hint, hint, hint to my students. Okay, for my students that get stopped out too much and who don't like to get stopped out, if you can find the other side of a good trade, you can then manage that trade more effectively. So for example, I could have taken off just the EXC trade down here, and I could have left the PPL trade running. Okay? Or vice versa, I could have taken off the PPL and left the EXC trade running. So what am I talking about? My students will know that as the order flow unfolds, okay, and you get confirmation of your idea, then you can, when you have two sides to a trade, you can manage that trade so much more effectively. Okay, so for example, my students know what to do right now on EXE. They know they should be buying. They don't know exactly where they should be buying just yet, but they know they should be buying, right? But on a bigger term, on a bigger time frame, my students would be shorting this, okay, which is why I short it, because if you go up to a larger time frame, it's actually a short. So start to think about that, and start to think about adding, using correlations into your trading plan, because it will just give you the ability to be able to manage trades far more effectively than just being naked on one side or the other. So like I said, this was not a big win. It was a real trade, but it's a way that, and I want to suggest, here's the other thing. You really can't do this until you have a very large account, because you're doing two sides to a trade, okay? And so you're going to be doubling your commission, right? And your expenses are going to, your cost is going to be far more. So if we actually take a look here, you can see I had to pay 2 commissions on this trade, right? So I had to pay $10, and then I had to pay another $7.35 approximately. So $17 worth of commission versus just paying a flat commission. Okay, now a lot of you know that I kind of criticize Anton Krill, and this is one of the reasons why I kind of don't like it when Anton Krill tells you guys that you can do what hedge funds can do. Well, you can't unless you have a large account. I can only do this because my account is large enough that I can take an adequate enough size to offset all that commission charge. Does that make sense? Right? But Anton will tell you that, no, it's okay. You don't need to, you don't need a large account. Just, you know, his course is not for retail traders. Even what I'm teaching you right now, it becomes very expensive for a retail trader to be able to do this because your costs. You get more safety, but your costs increase substantially. Okay? Show you how you can do it without trading earnings, just to give you guys an idea here. Let's say I was just watching this here, and I was watching regular order flow, and I see, let me go to a day here where I have some clarity here that my students can take a look at here. We'll go 5-day, 1 minute. Let's say that I was watching this on any other day, okay? My students will like this day right here, right? So let's assume on a day like this day right here, right? And we want to take a short here, right? So instead of just shorting, right? Instead of just shorting right here on the white one, remember, let's say I want to short EXE. If I short EXE here, but I also buy PPL, okay? I short EXE here, and EXE moves down to my target, right? Now I have two options, right? I can cover both sides, or let's say that I want to hold on to EXE because I can see that sellers are in strong control of this market on this day, and I want to hold that trade. Hint, 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 students, students, students. Okay? So I see that I'm getting strong feedback, but I don't want to take the trade off. I can now close my long side of PPL, and I can hold my short side. Does that make sense? Now I'm going to be in a loss on the long side, but when I see the confirmation of the market continuing and continuing and continuing, and my students will understand how we judge that, I'm now out of my long side. So I've taken a low risk trade. Now let's just pretend that the opposite happens. Let's pretend that I want to take a short here on EXE, but instead of it dropping, I'm wrong. Well, guess what? Chances are my PPL is going to rise with my EXC. Okay? Now, why is that significant? Well, that's really significant because now instead of me just taking a loss on the EXC trade, what if I get to a level that looks better? Right? So I really have a short bias on EXC, but I get to a level that looks better. I'm covered on that side, and when I get to a level and I see a better, quote unquote, my students will know what I'm talking about, value, then I can close the long side and I can just hold that short side. Okay? So again, this is what I am doing these days, and so why a lot of my students, if you might be asking, Steve, how come we don't actually see a lot of trades that we're doing within the course? It's because this is what you have to do when you're managing a large amount of money. But if you have a small $5,000 account, this isn't going to work for you guys very well because the commission cost is going to be super expensive. And that was my argument to Anton Krill when he's trying to sell you guys his institutional trading tools. And imagine you're doing this with 5 or 6 different assets. Your commissions are going to be astronomical. It's going to be very, very difficult to do it unless you can scale size. Does that make sense? Okay? So, that being said, this was a real trade, and I thought I'd talk about it. It was actually an earnings trade, not so much just an order flow trade. It was how I wanted to trade the earnings on this based upon a larger time frame. How you can use hedging in your trading in order to minimize your risk and manage your trades better. Okay? But unless you have a large enough account, this becomes very expensive. As you can see, I think I made $320 on the trade, and I think I paid, almost $17 in commission. versus just being right with order flow, taking a trade, paying one commission, and believe me, you might not think that's a big deal, but if you do 1,000 trades in a year, which kind of high, but you do 500 trades in a year, right? Those commission costs become astronomically expensive, right? Hope you guys enjoyed that little explanation. That was a live trade. Haven't done one in a while. And I wanted my students to understand, since I am now managing money, why I am not posting trades, just directional trades, very much anymore, right? Because I can't. I have to have a way for me to excuse me, to manage the trades better if the trade doesn't work out the way that I want it to. Okay? If the trade doesn't work out the way that I want it to, and especially in a very high volatile market, and we all know where the VIX is right now, right? The VIX is through the roof right now. You want to be able to have a way to make sure that you do not take too much risk. Okay? Hope you guys enjoyed that. For my students, I hope that helps you understand why specifically I am not putting directional trades in for you guys as of late, because when you manage large amounts of money, you have to have a way to be more conservative so that you don't have big situations where trades go against you and you don't have a more effective way other than a stop or a hard stop of managing that trade. That make sense? Hope you guys enjoyed that, and bye for now.